the number one reason why so many smart people suck at investing. Many smart people, because they're so smart, have a tendency to overanalyze their investing decisions. The world of investing and finance is quite interesting. In one sense, it resembles fields of hard science like biology, physics, and chemistry. Math is math, right? When you add 2 plus 2, you get 4. When you compound a dollar at 10% interest rate for many years, you eventually get $2. Yet in other sense, it seems to better resemble other fields like psychology and sociology. Stock prices seem to move based on human emotions rather than sound logic. So what's the deal? Is investing more like physics or is it more like psychology? Well, the answer is both. Sometimes it follows the hard laws of physics, yet at other times, it flows with the emotions responding to human psychology. That is because there are so many variables that play into how money, the stock market, and investing works. The broader economy, trade tariffs, price-to-earning ratio, and hard-to-measure elements like human greed and political turmoil. And the honest truth is that no matter how smart an individual may be, no single person can completely comprehend all these variables. And more importantly, predict what is going to happen to the stock market or a company value in the future. And I, recognizing my own intellectual limits, have come to that conclusion many years ago. Thus the reason I have settled on a simple index fund strategy as the best way to invest in the market. However, smart people, individuals that are way smarter than me, have a really hard time accepting this fact. The fact that they can't understand all the movements of the market. This is because many of them are used to being able to process a lot of complex information and digest them better than most people. The reason why many of them have successful careers and are really good in their day jobs. And they believe they can do the same with the market. They believe that if they can analyze enough data, they can understand what is going on and find a winning strategy to win in the market. So they go down the rabbit hole of reading everything about a company, the market movement, and all the books in stock trading, and they analyze, analyze, and analyze. And what is one major consequence of this overanalysis, which leads to the next reason why smart people suck at investing. The number 2 reason. Continuing in the theme of overanalysis, smart people have a tendency to overcomplicate their investing strategy. Because they feel they have a good understanding of what is going on in the market, the broader economy, and even specific companies, they come to believe they can configure the perfect investment portfolio and strategy. And in my eyes, most often an overcomplicated strategy. Here are a few common examples. 1. Stock picking. Many smart people, because they believe they have a good understanding of how one company will perform versus another, try to design their own stock portfolio. Or they might even go beyond just stock picking and try to invest in complex alternative assets that they believe can beat the market. 2. Market timing. Many smart people believe they understand the market trends. They know for sure that the market is at its peak. So they sell and wait until the market drops to buy again. Sounds great in theory, but the truth is that most people that try to time the market most often end up on the wrong side of the trade. 3. Asset stacking. Many, because they have a good understanding of how different asset classes will perform in different economic times, spend all their energy designing their perfect 18-fund portfolio, made up of large cap, dividend growth, 10-year treasury, and Pokemon card leveraged option fund. And the thought is that this perfectly configured portfolio will not only get better returns in the market, it is protected from any downside, and can even take advantage of market calamities. A big promise, right? The truth is that while a level of analysis is required to design a good investment strategy that works for you, in the world of investing, more is not always better. In actuality, more often does greater harm than good because it comes with additional costs and unnecessary complexity. Alright, but in addition to overanalyzing, what is another reason why smart people gravitate towards these complex and most often ineffective investing strategies? But before we get there, let me talk to you about a great free tool that can help you in your investing journey. Let's say that you're too smart for your own good, so you're already knee-deep in a pretty complex investment strategy. Multiple different funds, multiple different securities, all in different places. You can't keep track of what is what. If so, what is one of the first steps you can take to simplify? Which is why I'm excited to talk to you about Empower, who I'm partnering with for today's video. One of the first steps to simplify your investment strategy is to understand where you currently stand with your investments. How much is invested in what assets? Well, one of the major challenges with getting this information is that most often, this information is spread out in multiple accounts. Different brokerage firms, banks, and institutions. Well, this is where Empower can help with their free personal dashboard. Once you connect all your accounts, its amazing dashboard allows you to see in one place where you stand with all your finances. Additionally, if you want to get a better understanding of all your investments, Empower's investment checkup tool helps you to see your complete portfolio asset allocation in one page. Its retirement fee analyzer also allows you to see how much you're paying in fees across all your accounts. Remember, every dollar you pay in fees is a dollar that is not compounding and growing. All these functionalities and more are completely free when you sign up. So if you want to get a better handle of your finances, a better understanding of where you stand, I highly recommend you check out Empower today. Please go to my special link I'll have in the description below to get started with the free dashboard. Again, I'll have the link in the description below. Alright, with that, let's get back to the video. The number 3 reason why so many smart people suck at investing. In the line of overanalysis and overcomplication, overconfidence. Overconfidence in their understanding of the market. Overconfidence in their ability to spot patterns. Overconfidence in their ability to beat the market. Essentially, overconfidence in their own abilities to invest successfully. As I mentioned earlier, many smart people are very successful in their own right. They have successful careers, they perform well in their day jobs, and many make excellent money. Thus, many mistakenly believe that the same level of intelligence will make them great investors like Peter Lynch and Warren Buffett. They're confident their intellect will allow them to see patterns that others can't see. I mean, they do it all the time at work. However, investing requires a completely different set of skills, one that values patience, humility, and the ability to manage emotions over raw intellect. Smart people often assume that success in their given profession can translate directly to success in the markets, but the reality is that even the brightest minds can't consistently predict or control the complexities of the stock market. The number 4 reason why so many smart people suck at investing. Smart people have a hard time accepting the average. In this case, average returns. Smart individuals are used to being at the head of the pack, the first in their kindergarten class to learn subtraction, the first in their college major to graduate in less than 4 years, the first in their team to get promoted to management. They have never been the average and they have no plans to. Their life motto is to be at the head of the pack at all times. Thus, when they're introduced to the idea of average market returns for their investment portfolio, they look down at the notion. The average market returns? That is for the average, the commoners. I am no average. I have never been average. Thus, I cannot accept average market returns. And they go on the search for the investment vehicle that can do better than the market. You want to know the dark truth? The financial industry loves these kind of individuals. They have the perfect investment products for such individuals. Yes, of course, you shouldn't settle for the average. You're not an average, sir. Look how successful you are. Come, we have the perfect investment vehicle for you. Check out this fund managed by our top-tier investment manager. He's been listed by Forbes multiple times. Or do you want something more exclusive? How about this private fund that is only available for our special clients? It is sure to do better than the market. But what happens often is that similar to having an overcomplicated strategy, you're laden with very expensive funds that underperform the market. And in the rare few times that they do beat the market, the expenses wipe out any advantage. In the world of stock market investing, average returns are actually quite amazing. These days, with products like low-cost broad market index funds, you can get average market returns at rock bottom cost. And when you can get average returns for a long period of time, they can make you quite wealthy. You may have been above average in your GPA, but when it comes to investing, accept the average. You're actually showing your real intelligence when you can accept the average and be content. Alright, before we get into the next reason, let me share with you a free gift that I'm confident could help in your investing journey. Do you ever wonder what type of an investor you are? Are you more risk tolerant or are you more conservative? Or maybe you're more open to the international market. Well, if you are, you're in luck, my friend. By answering just a few questions in this investor assessment quiz, you can receive a free customized investing plan. It will not only show you what type of investor you are, you'll also get a sample investing portfolio, plus tips to make sure you stay on track to meet your investing goals. So make sure to go to the link I'll have in the description below to receive your free investing plan. Alright, with that, let's get back to the video. The number 5 reason why so many smart people suck at investing. In the line of smart people having a hard time accepting average, many have a tendency to pursue novelty instead of consistency. As we talked about earlier, the market is made up of a lot of elements. The economy, political agenda, individual company performance. And it is hard to know how and what is going to move the market in whichever direction. So one of the best weapons against unpredictable market movement is consistency. Consistently investing in the market over a long period of time. However, as you can guess, this is a very boring strategy. There is no problem to solve. There is no pattern to decipher. You're just believing in the long-term growth of the stock market and essentially focusing your energy on other things. While smart people who are used to solving complex problems, complex puzzles, have a hard time with this boring approach to investing. Thus, they tend to seek out the novel, the unconventional, because they seem more intellectually stimulating. We're in the era of artificial intelligence. So what companies are best leveraging AI and machine learning to transform their business? Crypto is a new currency. Traditional banking is dead. What decentralized finance platforms are yielding the highest returns? All the ultra wealthy are holding alternative asset classes. They hold their value regardless of the market. What fine art, vintage wine, or rare collectibles should I invest my money into? Now, some of these investments might have a place in your portfolio one day. a small place, and as long as they have a clear goal. However, we shouldn't purchase an asset because of their novelty factor. That is not investing. That is just buying a trophy asset because it seems cool. The number 6 reason why so many smart people suck at investing. They confuse activity with productivity. In many fields, hard work, more work often leads to better outcomes. If we want to become better writers, we must write more. If we want to become better musicians, we must practice more. If we want to build a better body, we must walk more and lift more. But investing, ironically, it doesn't work out that way. More activity does not lead to better results. It is actually the opposite. The more we tinker with it, worse the outcome. A while back, Fidelity released a study discussing a performance breakdown of their accounts. Essentially, what was the profile of clients who had the best returns? Do you know who the best performing clients were? The dead ones. And the second best? The clients who forgot that they had a Fidelity account. Essentially, those that did the least with their accounts, essentially set it and forget it, did the best because they allowed the market to do its thing, allowing the compounding to take its full effect and appreciate the account's value. Constant effort and optimization is a useful trait, and smart individuals understand that fact. However, do not think that constant effort in investing, such as checking your portfolio daily, tweaking asset allocation constantly, and trying to time the market will yield better results. The best investors understand that investing is one of those few areas in life where doing less is actually doing more. True productivity in investing comes from patience, discipline, and letting compounding do the heavy lifting, not constant tinkering. Number 7 reasons why so many smart people suck at investing. Many are so darn busy. Too busy to spend the time learning about the basics of investing in money. While we can't completely comprehend all the variables that move the stock market and we can't predict where the market is going to go, there are basic investing principles that we have to understand if we want to become good long-term investors. Diversification, taxes, management costs, asset types, etc. However, what I've seen with many smart individuals is that many of them do not have a good understanding of these basic investing principles. And that is not because they're not intelligent. No, the opposite. They're very intelligent, which often leads them to having very demanding jobs and positions that require much of their time. A corporate executive is a master at marketing a billion-dollar brand, but because they're spending all their time thinking about the next brand deal, they don't have the bandwidth to look at their 401k and investment options. A neurosurgeon is a genius at doing brain surgery, but because they're spending all their time either in the operating room or getting ready for the next surgery, they don't have the time to review their asset allocation and what they even mean. And what happens is that while they're geniuses in their own chosen field, when it comes to basic personal finance and investing decisions, they don't make wise decisions. Or worse yet, they mistakenly entrust that responsibility to someone else, which leads to the next reason. The number 8 reason why so many smart people suck at investing. They outsource too much. Smart individuals with demanding careers don't feel that they have the time and bandwidth to devote to their investing. So they come to rely on so-called professionals to manage their money for them. These companies have fancy names and individuals with fancy titles and fancy experiences. And they tell these smart individuals, "Sir, you don't have the time, but we do. We can devote our time, energy, and soul to ensure your money is well managed." And because you're so busy, you want to believe them. And you also think, that is what rich, smart people do, right? I'm sure Jeff Bezos or Elon Musk don't manage their own investment portfolio. They have smart people doing that. So I should follow their footstep. Yes, I'm sure if you're a billionaire, you're not spending your time thinking too much about asset allocation and monitoring expense ratios. But here are the facts. 1, we're not billionaires. So that argument is not relevant. And 2, for common folks like you and I, we don't need a crazy, sophisticated strategy when it comes to investing. A simple strategy that we follow over a long period of time will work for most of us. When it comes to investing, outsourcing often does more harm than good because most of these investment firms will try to get you into a complex strategy, an expensive strategy that is often unnecessary. No one will care more about your money than you. So if you're choosing to outsource, make sure you're driving the decision, not them. Number 9 reason why so many smart people suck at investing. Paralysis by analysis. Alright, so you're smart, but you're not so smart that you spend all your time trying to beat the market or try to time the market. However, you get caught in the other extreme. You get caught in a never-ending cycle of overthinking and second-guessing every investing decision. Should I invest in a large cap fund or the middle cap fund? What percentage of internationals should I hold in my portfolio? Do I need a bit of real estate? If so, how? Buy a REIT? Or should I go out and just buy a rental property? Or how about a crowdfund investment? I heard they're pretty popular these days. And you spend countless hours thinking through all these questions. Now, to think and plan is important, especially when it comes to investing. For some of us, we probably need a bit more sitting and thinking before making a decision, making a move. However, for some of you smart individuals, you may spend maybe a bit too much time thinking and analyzing instead of acting. You fear the wrong decision. You feel you need more information, so you wait and wait, caught in analysis paralysis. I have seen people holding at times hundreds of thousands of dollars in cash because they were afraid to invest, to make the wrong decision. We don't want to be rash with our investing decision. We don't want to go out and buy a bunch of assets in the hopes of beating the market. But we also don't want to be so scared of making the wrong decision that we don't do anything. When we don't give our dollars the opportunity to appreciate and grow, they're losing value every day due to inflation. The number 10 and the last reason why so many smart people suck at investing: impatience. Specifically, impatience with the slow process of building wealth. I'm a firm believer that for the most of us, the proven and sure path to winning in investing is a slow and steady path, mitigating risk by diversifying as much as possible, maximizing our returns by watching our cost, and giving our dollars a greater chance of growth by holding assets over a long period of time. However, many smart individuals tend to be impatient. This is because smart people often excel in fast-paced environments where results are immediate. They're used to solving complex problems quickly, receiving instant feedback, and seeing immediate rewards for their efforts. But this mindset clashes with the nature of investing, where compounding takes years, if not decades, to show its full effect. Don't let this be you. You're not just a smart individual, but you are wise. So drink the Kool-Aid with me, and let's build our wealth slowly and steadily. Thank you guys for watching the theme of slow wealth. Please check out my video here on why I believe you should pursue slow wealth. Until next time, all the best.